there's a question that almost nobody asks, and it should terrify anyone who owns a gold ETF. Why does the same ounce of gold, the same purity, the same weight, sometimes trade for a different price in Shenzhen than it does in Zurich? Gold is supposed to be the one asset on Earth that means the same thing everywhere. A gram is a gram, whether it's melted in Switzerland or minted in Shanghai. And yet, for years, a gap has quietly opened between what gold costs in the East and what it costs in the West. That gap is not a rounding error, it is a symptom. And in the summer of 2026, that symptom turned into a full diagnosis, because China just performed surgery on its own gold market. Stick with me, because by the end of this video, you'll understand something most financial commentary completely misses. This isn't really a story about gold going up or down. It's a story about who gets to decide what gold is worth in the first place. And once you see that question clearly, you can't unsee it in every headline about gold prices from here on. Let's start somewhere unexpected, not in a bank vault, but in a Swiss refinery. There are only a handful of refineries on the planet capable of casting what's called good delivery gold bars. These are the 400-ounce bricks that move between central banks and bullion vaults. 4 of the largest sit in Switzerland, near the Italian border, in a town most people have never heard of. For decades, those refineries were the invisible plumbing of the entire gold world. Gold would arrive as scrap, jewelry, or mined ore from Africa, Russia, or Australia. It would get melted down, recast into standardized bars, and shipped onward, often to London, sometimes to New York. London and New York weren't just cities with vaults. They were the courtrooms where gold's price was decided. Think of it like this. Switzerland was the factory, but London and New York held the pricing pen. That arrangement made sense in 1975. Back then, Asia was a minor player in gold demand, and Western central banks held the overwhelming majority of the world's monetary reserves. Even the idea of a private Chinese citizen legally owning gold bars was, for much of the 20th century, essentially unthinkable. It makes far less sense in 2026, because Asia, and China specifically, now consumes more physical gold in a single year than the United States and Europe combined. Here's the imbalance in one sentence. The people buying the most gold have had the least say in what it costs. That's the setup. Now let's talk about the 2 casinos. Imagine gold trading as 2 separate casinos operating on opposite sides of the planet. Casino 1 is in New York and London. The chips at this casino are called futures contracts and derivatives. You can buy and sell an enormous number of chips without ever touching an actual gold bar. In fact, on most days, the total value of chips in play is many, many times greater than the actual gold sitting in the vaults backing them. That's not a scandal. It's how every major commodity market in the world functions, from oil to wheat to copper. Nobody expects every wheat futures contract to end with a truckload of grain showing up at their door, and gold has largely worked the same way. The assumption underneath Casino 1 is simple. Almost nobody actually wants to walk out with the metal. They just want to bet on its price. Casino 2 is different. Casino 2 is where grandmothers in Mumbai buy wedding bangles. It's where Vietnamese families store savings in gold bars, because they've watched their currency lose value within their own lifetimes. And it's where Chinese households have, for generations, treated physical gold as the one asset a government cannot quietly erase. In Casino 2, people want the metal. They want to hold it, wear it, bury it, pass it to their children. Ask anyone whose family lived through a currency collapse, and they'll tell you why a gold necklace matters more than a bank statement. For most of modern history, Casino 1 set the price, and Casino 2 simply accepted it. That's the part that just changed. Not gradually, but with a specific date attached to it. On June 25th, 2026, Industrial and Commercial Bank of China made an announcement. It's the largest bank on the planet by total assets. It said it would end all retail leveraged gold trading tied to the Shanghai Gold Exchange, effective after settlement on July 24th. Within a single day, 3 more of China's largest banks made the identical announcement. That kind of synchronized timing doesn't happen by accident in a market this size. Now, if you only heard the headline, you might think China was cracking down on gold ownership. That would be the wrong conclusion. And it's worth slowing down here because the details matter enormously. What's being eliminated are the leveraged products. These are the deferred delivery contracts that let a retail investor put down a small deposit and control a gold position many times larger than their actual cash. Picture a Shanghai factory worker depositing the equivalent of 2 months' salary. Through leverage, that deposit ends up controlling a position worth 5 or 6 times that amount. It's essentially the same mechanism as trading on margin in a stock account, just applied to gold instead of equities. When gold moves against them by even a small percentage, that leveraged position can be wiped out in hours. That triggers forced selling that has nothing to do with how much physical gold anyone actually wants. That's Casino 1 behavior. Bets stacked on bets. Except it had quietly crept into what was supposed to be Casino 2, the physical stronghold. What's staying completely untouched? physical gold purchases, gold savings accounts, accumulation plans, gold-backed ETFs on Chinese exchanges, institutional trading on the Shanghai Gold Exchange itself. In other words, China isn't closing the casino. It's removing the poker tables from the temple. Why would a government do this? Here's my read on it, and I want to be upfront that this is analysis, not a press release from Beijing. A leveraged retail market is fragile by design. It amplifies moves in both directions. When gold rallied to an all-time high above $5,500 an ounce in early 2026 during Asian trading hours, leveraged long positions in Shanghai poured fuel on that rally. When gold then fell roughly 30% in the months that followed, many of those same leveraged positions were liquidated in forced margin calls that added selling pressure that had nothing to do with how much physical gold Chinese households actually wanted to own. So China's domestic gold price was being whipsawed, not by grandmothers buying bangles. It was being whipsawed by retail speculators making the same kind of leveraged bets that already dominate Wall Street. If you're a government trying to build a gold market that reflects real physical demand, that volatility is a liability, especially if your goal is to eventually stand as a credible pricing alternative to London and New York. Think about it from a policymaker's chair for a second. You cannot build a trustworthy pricing benchmark on top of a market that swings 30% because of retail margin calls. And that brings us to the piece almost no one is connecting properly. This shutdown didn't happen in isolation. 17 days before the leverage ban took effect, on July 7th, Hong Kong quietly launched something called the HKIPG Gold Benchmark. It's a new physical gold pricing mechanism backed by over 40 founding financial institutions. HSBC alone committed 200 metric tons of vault space to support it. For context, London's gold pricing benchmark has existed in some form for over a century. This is the first serious attempt to build a parallel system anchored not in derivatives, but in physical metal sitting in Asian vaults. It's worth pausing on how unusual that is. Most financial infrastructure this significant takes decades to earn credibility, not weeks. Now overlay the import numbers. China brought in roughly 163 tons of physical gold in May of 2026 alone. That's the strongest single month in over 2 years. Year-to-date physical imports were running more than 75% above the same period the year before. Meanwhile, the People's Bank of China had added to its official gold reserves for 20 consecutive months. Multiple independent analysts believe the real total sitting in Chinese vaults is higher than the officially declared figure. That's because sovereign gold accumulation is notoriously opaque by design. Governments rarely announce exactly how much of a strategic reserve asset they're stockpiling in real time. Do you see the pattern forming? Leveraged paper trading, removed. Physical import volume, surging. A new physical pricing benchmark, launched. Central bank accumulation, accelerating for nearly 2 straight years. Individually, each of these is a policy footnote. Together, they read like a blueprint. Let me offer you an analogy that I think captures what's actually happening better than any of the technical terms. Imagine a company that, for 100 years, has set the global retail price of coffee from a single trading floor in one city, even though the country actually growing and drinking the most coffee is somewhere else entirely. That arrangement survives only as long as the coffee-growing country doesn't build its own exchange, its own storage, its own settlement system. The moment it does, the old pricing floor doesn't collapse overnight. But its authority starts eroding, sip by sip, harvest by harvest. That's what's happening to gold pricing right now, except instead of coffee, it's the asset every central bank on earth uses as a reserve of last resort. Let's talk about why this matters, even if you've never bought a single gram of gold in your life. Roughly 20% of the world's population lives in China. Add in India, Vietnam, Thailand, and the broader Asian gold buying culture. You're talking about the demand base for a huge share of all physical gold pulled out of the ground each year. When that much real-world demand starts pricing itself independently through its own benchmark, settled in its own vaults, something important happens. The Western paper markets don't just lose a little influence. They lose their built-in excuse for why the price can diverge from what's physically happening on the ground. Here's a story that puts this in perspective. Back in March 2020, when COVID first froze global logistics, something strange happened in the New York gold futures market. Airline cargo routes that normally shuttled gold bars between Europe and the United States shut down almost overnight. Suddenly, traders holding futures contracts that were about to expire had a real problem. They couldn't physically get bars to New York fast enough to settle their obligations. The gap between the futures price and the physical price, something that's supposed to be nearly invisible, blew wide open for weeks. At one point, that spread reached levels that hadn't been seen in decades of gold trading. The Federal Reserve and the Bank of England had to step in and coordinate emergency shipments just to calm the market down. That single event is a preview of what happens whenever the assumption underneath paper gold gets tested. That assumption being that almost nobody will actually demand the metal. Now imagine that same stress test. not caused by a temporary airline shutdown, but by a structural permanent shift in preference toward physical settlement across the world's largest gold-consuming region. That's not a one-week disruption. That's a multi-year gravitational pull. There's a second historical parallel worth knowing, one most viewers have never heard. In 1968, the so-called London gold pool collapsed after Western central banks spent years trying to hold gold's price artificially fixed at $35 an ounce. They kept selling reserves into the market to suppress the price, until they simply ran out of gold willing sellers could supply. Within a few years, gold was allowed to float freely and eventually climbed to several $100s an ounce. The lesson from 1968 isn't subtle. Price suppression built on finite physical reserves has a shelf life, and that shelf life ends exactly when real-world demand refuses to cooperate. Some analysts see an echo of that same dynamic in today's paper gold system, just with China playing a very different role than it did in the 1960s. Let's talk numbers, because I promised you research, not just narrative. JP Morgan has projected gold reaching roughly $6,000 an ounce by the end of 2026. That number reflects exactly this convergence thesis, that physical demand out of Asia eventually drags the Western paper price upward to meet it. The World Gold Council's own survey work found that the overwhelming majority of central banks, north of 80%, plan to keep increasing their gold holdings over the coming years. A separate finding from that same body showed a strong majority of central banks expect their dollar reserve holdings to shrink over the next 5 years. The European Central Bank has noted that gold now represents a larger share of global official reserves than U.S. Treasuries do, a quiet but historic crossover. Think about what that actually implies for a moment. For the better part of 80 years, U.S. government debt was considered the safest, most universally trusted reserve asset on the planet. Gold, now edging ahead of it in official reserve allocation, is not a small technical footnote. It's a signal about how central bankers privately view risk in a world of expanding sovereign debt. None of these are fringe numbers from gold bloggers. These are institutional projections and central bank survey data. So here's my honest take, and I want to separate this clearly from the hard data I just gave you. I don't think July 24th, 2026 is a single dramatic trigger date where the gold market flips overnight. Anyone selling you that story is selling you drama, not analysis. What I think it actually represents is a marker, a clean, documented point in time where you can look back and say something specific. This is when the world's largest physical gold buyer stopped letting its retail market mimic Wall Street's paper casino and started building infrastructure to stand entirely on its own. It's less like an earthquake and more like a tectonic plate that's been drifting for years, finally crossing a line on the map. Tectonic shifts don't make headlines on the day they happen. They make headlines decades later when someone finally draws the new map. So what does this actually mean for you, sitting there watching this video? If you own physical gold or a gold ETF that holds real allocated bars in a vault, here's what matters. It's worth checking your specific fund's prospectus because not all gold ETFs are structured the same way. Some genuinely hold allocated bars in a vault with your name effectively attached to specific serial numbers. Others are structured very differently, and the fine print matters more than most investors realize. But this broad shift in physical demand and pricing power is generally a supportive backdrop. If your exposure to gold comes through leveraged trading products, futures speculation, or short-term paper positions, listen closely. The lesson here isn't panic, it's awareness. You are participating in the exact casino that's losing its uncontested pricing authority. That doesn't mean that casino closes tomorrow, but it does mean its house edge is shrinking. And if you own no gold at all, this still matters. It's at minimum a fascinating case study in how monetary power actually shifts in the real world. Not through dramatic declarations, but through spreadsheets, import tonnage, vault capacity, and a bank memo announced on a Tuesday in June. History rarely announces itself with fireworks. It usually announces itself in a regulatory filing nobody reads until years later. Here's the question I want to leave you with, because I think it's more interesting than will gold hit $6,000. For 100 years, 2 cities decided what an ounce of gold was worth for the entire planet. What happens to global finance when that's no longer true? Not because of a crisis, not because of a war, but because the world's biggest buyer simply built its own scale and stopped asking permission. I think we're watching the early chapters of that answer being written in real time. And most people won't notice until the final price is already set. That's usually how the biggest shifts in money work. Quietly, then suddenly, then permanently. If you found this breakdown useful, subscribe. I'm going to keep tracking this story as the Hong Kong benchmark builds volume and as China's import numbers roll in month by month. I'll also be watching whether other major gold-consuming nations start following a similar playbook. Because if this pattern spreads beyond China, the story gets much bigger than one country's regulatory decision. Drop a comment and tell me, do you think physical demand from Asia can genuinely challenge 100 years of Western pricing power? Or is this overstated? I want to hear the disagreement, not just the agreement. Tell me which side of this you're on and tell me why. Thanks for watching, and I'll see you in the next one.